And everybody, it's Tim Reazor with Revere Asset Management, just after 3:30 here on a Wednesday night. So very quickly, stock nerds and market lovers, before you and I begin tonight's sojourn, I want to tell you a couple things. One, it is, my friends, options expiration week, so it's OPEX. So look, today's move could have been an aberration, but I don't think it is. And I'm going to show you where, by the end of this video, I'm going to show you why I think Apple eventually ends up at $112. And where I think SPX or SPY is headed to, and just lay out a scenario for you. And then I want to show you the one chart I believe that would cause the market to crash. I'll show you that as well. And then what we did today here is we taped the podcast early. And so today was a big day in the markets. We had to tape the podcast anyway, and it just happened to be a big day. But I think, in my heart, the last 2 weeks of podcasts have been the best that we've ever done. The strategy mentioned here in episode 400, it'll keep you on the right side. If you watch the video or listen to it, it'll keep you on the right side of any trade you ever make. And if you have any questions on that, you can, of course, get a hold of me. I'll show you how to do that here in a second. And then today, if this chart breaks, markets will crash. Boy, there's just so much goodness in today's video to help you navigate the markets. And it's not this is bad type market. There's some really practical, helpful discussion in here I think that you can benefit from. And then if you have any questions about anything we talk about, you don't like the tone of the videos, don't like anything that I'm doing, or want to see our portfolios, just click the About button, strategy button at revereasset.com. Scroll down. All you have to do is scroll down, and then you can get a hold of any one of us. Here I am, Tim at revereasset.com. There's my Twitter handle. I'll show you that in a second. And then if you want to talk to the fellows that make all the decisions in the portfolios, what goes on the watch list, what comes off, what buys, what sells they make, it's Hunter and Don right there. And then America's fiduciary right here, Dan. So let me tell you something about Danny right now. He's taking a bunch of phone calls, and whether you're a client or not, we want you to call us. And only because we know a bunch of people are hurting right now, and you need someone to talk to. Well, like, is this, of course we're not soothsayers. We don't know everything that's going to happen in the markets, but we do have strategy. We can show you, and Danny can absolutely tell you in great detail what our strategies have done this year, how we've executed, how we protect clients in markets like this, and or if you just need someone to talk to. I know there's a bunch of people hurting out there, and it's not a sales pitch. Look, we just know markets are lonely, and a lot of you have buy and holders in your lives, whether either your advisors or people in your family, and we think we can be of help even if we just talk. And so just call. Look, we'll never email you, we never spam you, so you don't have to worry about it. 855 Real Wealth is the phone number, or if you're on a connected device listening to me right now, just hit the phone button at Revere Asset, and it'll connect you right to Danny. And if it just happens to be dinner time, he'll call you right back. Okay, so with that, I showed you the podcast. I talked about how to get a hold of us. Look, one last thing here. My DMs are always opened, so people send me messages all day. You're more than welcome to. At TJ Reazor is how you get a hold of me on Twitter, if you are so inclined. My email gets jammed up, but my DMs are pretty quick because you guys limit how many characters you use, and it's brevity, and I really do appreciate you for that. So with that, stock nerds and market lovers, these videos are for what? Your edification purposes only. They're never ever to be misconstrued as advice. When advice, anybody seek advice, all you have to do is, in fact, give us a call. So look, let me show you something here that the market's got a little bit of complacency, and so we're at, you're going to say, how can it be a complacency? Did you see the almost 4% sell-off in SPX and more in the NDX? Yeah, I did. And look at this. This is curving up 10-day moving average, the per call ratio. And normally I tell you this is where you want to start looking for a bottom. And it's options expiration this week, so maybe this is it for the week, and the market will moderate a little bit higher as we go on to that monthly options expiration for May. But the market's not scared here. And you could be like, well, Tim, it's at over 1. Surely it's scared. No, it's not. It would be, the market closed pretty I wouldn't say it was a great close. And the market didn't close at the high for the put call ratio, which was higher just a couple days ago. Is the market getting used to this level of price is what I'm kind of suggesting. And it might be. Are puts cheap? You know, if puts were expensive, this put call ratio would be higher. And the VIX would be a little more inverted than it is here. This VIX was not inverted till the very end of the day, 3164. 3145, 3108. So yeah, the VIX is inverted and you're showing a little risk right here, but it's not grotesque. It's not like it was back in February after the initial drop. So it wasn't like just it was a couple weeks ago when we had that next big drop. And so my thought to you here, stock owners and market lovers, is that the market's kind of getting used to what's happening. And that used to what's happening is kind of like an apathetic approach, and that apathy is complacency, and that complacency leads to more pain. Doesn't have to happen tomorrow, but it's probably coming. And so let's talk about this. Let's talk about 40-week moving averages. So there's a couple ways to see the pathway that markets are on. And so we're on a weekly chart here, not a daily, but a weekly. And you can see here, I've got fib levels from top to bottom. And I'm just looking grotesquely here for 50% retracements, the 618 and the 786, and they're like cattle fences. We've had the fib discussion before, you and I. And if you have any questions on this, you're more than welcome to email me. Or, you know, oftentimes people hear what I'm saying, but don't quite understand it. Danny is like the best interpreter there is, and you can call him anytime or email him. He knows everything, so he'll be more than happy to explain what I'm saying to you if you need a little bit further help. But once these fences are broken, it herds the cattle to the next level. We haven't broken through the 618, which is 38.15. But it makes sense to me that before this is done, we come back down here to the 50% retracement level from high to low around 3,500, which now coincides with the 40-week moving average. And so I would think that's a buy at 3,500. And so to give you a little historical context here, when is the last time we flirt with the 40-week? Well, on this side of the 2010 area, right? So you can see down here, between 2010, 2011, right there. Here's 2015, and then this is interesting to me here. We come down to the zone of the 40-week. And that is 2018, the last time where they raised rates. This time, when I say this time, it's different this time. What I mean is we're in the largest quantitative tightening cycle in the history of the United States right now. We're going to pull the Fed buying. We already have pulled the Fed buying, and we're raising rates. That's not been done before. And for those folks who think that it can't get any lower, S&Ps, if we're following the 2000, 2001 time from 1999 to 01 around terrorist attacks, you have about 30 more percent, 25, 30 more percent to go in S&Ps, maybe 40 more percent down to hit lows in the NDX. And I did that for you. If you're like, well, Tim, show me that work. I've done all of that for you. And all you have to do is, if you want to see it, go to Revere Asset, Tomorrow's Insights, and then you click the podcast tab. And all that work on how much further we can fall and following that 1999 through 2001 model is in episode 400. And I think it's really important you understand that, because what you're going to have is moments of reprieve. And the markets, by the way, got within about 10% of their all-time highs in 99 to 2000, and then just rolled over, and it was unsustainable. And so I think it's really important. History doesn't repeat itself, but it often rhymes, is the phrase. And so that's probably what we're doing right now. We're following that kind of 1999 to 2000 time frame, and I think it's important that you understand that, because you don't get wedded to this is over mentality. The Fed is not done creating demand destruction. It's understand that consumer confidence has been eroded too. It's just started. It hasn't been. It's just started. Walmart is down it was down what yesterday? Let's see, I'll just do it with you here. This is a week, okay? So in a week, and we're only 3 days into the week, let me get my, I'm gonna leave it on the weekly chart. Walmart this week is, from high to low, is down, that's, oh, let's do the daily chart. That's not, it doesn't show you the way I wanted to. This is some interesting, so right here to, where do we close at? 122, somewhere right in here is down what? 17, 18%. Like that's nuts. Target today, TGT, is down 25%. That Target today lost a quarter, 25% of its market capitalization in one day. It's more than expenses. It's also consumer confidence. And with the consumer, we're 70% service-driven economy, consumer-driven economy. And so you're seeing things start to crack right now. And you're like, well, Tim, they've already been cracking now. It's showing up in other parts now. And this is the time where I think stocks start coming for their 40 weeks. And so what do I mean? Individual stocks like Target's 40 week is all the way down here at 148, right? Walmart is all the way down here. It eclipsed it, okay? It eclipsed at 124. And so that'll be a line in the sand, right? But the SPX, as I told you, on a weekly chart is all the way down here about 3480, which coincides with that 50% retracement. And that kind of makes sense to me. Now, does it have to happen? Of course not. None of it has to happen, but the setup is there. You've got these failing rallies starting up here. Can't hold the zone of the 21, and then can't hold 21, can't hold 21, can't hold the 5, can't hold the 8, can't hold the 5. And so is it all going to happen in one fell swoop? No, the crash hasn't happened. There hasn't been the whoosh yet, the panic waterfall selling. I mean, you're like, Tim, but the SPX is down 4% today. This was mechanical today. We need something that just makes it go limit. We haven't had the volume-esque whoosh yet. And you'll know it when you see it. There isn't the panic there yet. The put call ratio, like let me see if I can get this to 2020 levels here. So there's 2020. Like look at where the put call was up in March, right? Like we're on a track to try to give up these gains here since 2020, and you're not even getting these type of spikes. You need to see a little bit more fear in this market, and it's just not there yet. And that fear comes from a whoosh, and that's where great opportunities come from. And so where do I think that moment comes from? Probably like if you got an Apple, and it's not that far off. Look at Apple here. Like, let's keep it on the weekly chart. Let me see if I can make this a little bit different. So here's the COVID low to the COVID high, or we'll call it the COVID high. And all you've done is come back to where we'll call this the zone of the 618. 133-ish is the 618. If you break 133, now that next level here is the 118. We'll call it the 120 to 112 zone. It's right in here where I'm drawing this rectangle. This is where I believe Apple comes down to. And it doesn't quite get me. Do I think Apple gets to its 40 week? Look, anything can happen in a market, but this is the path I believe markets are on. And that brings you inside. This would be a pretty strong level right here, this 112 level, this 120 to 112 level. So I think that's where the trajectory you're on, whether you get there or not in this month, next month, it's setting up. And I think caution is warranted, and we cover what our plan is. If you if you watch this week's podcast, Don talks about all the positions, all the moves. We talk about our strategy, and we lay bare exactly what we're doing. And so I think that's enough. Like, this video isn't that long today because there's just there's so much happening, but I've covered it with you. Like, we've been together this whole journey, and I think you've got the resources to help yourself. I wish everyone who watched the videos was a client, but whether you're a client or not, we're here to help empower you, answer questions, and you know, work through these type of markets together, because we love individual investors. That's what we live for. And so if you do have any questions, watch this video. If you haven't seen it yet, Avoiding the Crash, watch this video, and then let's do one more thing together. And then just give us a call, 855 Real Wealth. Hit the call button right there. This is a chart you really want to get familiar with, and it's a credit chart. So a lot of people talk about, well, the credit markets freeze up, the credit markets freeze up, and you need a way to see credit markets freezing up or slowing down. And so we can use into the Great Recession here, and you can see consumer credit hits a high in July of 07, and then look at what happens. It's just month after month after month after month, and until it went extremely frozen, right? And then you can see here, this is into 2018, credit peaks, and it goes month after month after month after month until it goes negative. And if you remember, excuse me, into 2020 there. But if you remember let me pull you 2018 up. There's May, it's the end of 2018. Right in here, I apologize, it was in the wrong area. It slows down a little bit. And if you remember that 2018 time frame, in December, the fourth quarter of 2018 was really bad, but especially December, the market lost about 20% of its value, like lickety split, if you remember that time frame. And then look here, credit peaks, okay, in 2019, keeps coming down as the pandemic grows till it hits home, right? Credit markets are locked up. And then what does this represent? Why is this happening here? This is the Fed providing liquidity, or unfreezing the credit markets. This is the Fed providing liquidity, or unfreezing credit markets. Gulf War recession. This is the Fed providing liquidity. This is credit markets locking up. How about the 87 crash right in here? So credit markets, February, right? And then eventually what happened in October? Markets, so there's right in here. If I zoomed in, you'd see it, credit coming down. So this isn't an instantaneous read. It's over time, but you need to understand that consumer confidence and credit markets go hand in hand here. And I think Walmart and Target are a stance on consumer confidence. And now, was this the peak of consumer credit? And if you see this chart start doing this, that's probably what gets you to a bottom. Okay, so look, a lot to discuss, more in-depth discussion on all of this in this podcast right here. So please, I implore you to give it a listen. So with that, I hope it helps. Hunter's got your video tomorrow night, and then Don, of course, has you Friday into the weekend. So with that, I'll see you at the next update.